is CN's CEO, and he is with us now. JJ, thank you very much for being with us. And I guess I want to start there. It's safe to say we could figure out the numbers that are disappointing, right? Nobody likes the year-over-year decline. So just give me your own headline of what the quarter looked like to you.
So we had sequential improvement of a volume, of the freight volume, from July, August to September. The economy is coming back. We're cautious about how fast it's coming back. The real news is the fact that the freight economy that we serve right now, post-COVID, is different than the business that we had pre-COVID. Namely, Canadian energy space still hasn't recovered any, whether that's crude, frac sand, or refined product. And what really has recovered fast is the port business, the imports, the housing starts related to lumber, and domestic intermodal. So right now, volume is back, but it's back into a different mix than what we had pre-COVID. And that had an impact on the pace of revenue growth versus volume growth.
So then let's talk about that mix that changed. Grain was very strong. There were some other places of weakness. How do you feel about the business? And I guess I have to ask you, of course, still, JJ, how you feel in the context of the pandemic and then sort of more longer term structural changes you might be seeing.
Yeah. So right now, in terms of volume and operation, the railroad is very busy, especially Western Canada. Anything has to do with grain has been good, even during the second quarter, which was the bottom of the economy. The grain did fairly well. So grain is very busy, both Canada and U.S. The consumer economy is very busy. The fall peak is very busy. The first product is still holding on. As I said, energy, not as good as it was. In fact, it hasn't improved at all. So what really needs to happen here is at some point on our own side, proactively manage our mix and make some of these other segments, which are growing very fast, to be more profitable in the future. And then also focus on some of the areas of the bright spot, which are really secular long-term gain, like the slow movement from the West Coast trade to the East Coast trade, the unique cost and service mode. We have a price support for everything, including export of grain and coal and propane. And in the GTA in particular, we have a big project to open up a container terminal in Milton, which we're waiting for the approval of the Ministry of Environment. And we hope that this will come in before the Christmas holiday.
So given that you have seen these areas of improvement, I know you've brought on new rail cars for certain types of shipment. Are you fully staffed again compared to what you had to do at any time during the COVID layoffs? And will any of that change as we see the numbers pick up, JJ, with increased cases here?
Yeah, so it's a very good point because we had, very significant layoff in the spring. Many of our employees had to, we had to be furloughed. Many of them actually are back to active service. So they have their paycheck back. They can look after their family, their mortgage. That's really true in Western Canada. And to a smaller extent, we still have some people to call back in the U.S. and Eastern Canada. But a lot of our people are back to work, especially the union employees. Some more to come, I think, as the business is picking up in the fall. And typically the winter, does require more employee, no matter what the business level is. So we are currently hiring. We have actually reopened our training center in Winnipeg and Chicago to actually train people to be qualified railroaders in 2021, in expectation that volume demand in 2021 will actually be even further improved than what it is right now. So from a volume point of view, it's an indication that things getting sequentially better. All that again with a word of cautious. From a financial point of view, we have a different mix. The good news is our free cash flow year to date has been $2.1 billion, which is a good $580 million better than last year. So that is something that the team is very proud of.
All right, we do have a bit of breaking news here, JJ, if you'll bear with me, because we were waiting to hear from NDP leader Jagmeet Singh about whether the NDP would support opposition party motion that may have brought the government down. It appears the NDP will not support that motion, which was to bring an investigative committee to review, among other things, spending for the pandemic. Good news for anybody, I suppose, who didn't want to head back to the polls in 6 weeks' time or so. From your point of view as a CEO trying to work through this, I mean, the government was very responsive in the spring, obviously. There have been, I guess you might expect, with billions of dollars flowing out the door, questions here and there about how well it's gone. How would you rate the performance of Canada's reaction to COVID from a government point of view?
Yeah. I'll leave that to the citizen if they have to go back to the poll and make that decision. From a business point of view, we work with what we have. COVID has been extremely difficult for all nations, Canada included. And what's key for us is what is the kind of freight right now that needs to move. Definitely not forest product, definitely consumer product, not so much energy. Energy is not really related to Canadian politics. It's related to world demand, which has been down, obviously. So what we're looking for is, anything that could create a more stable economy. The recovery is still early stage, so that would be good, I think, for all involved. If any environment that we can create, that would create some kind of an improved stability in the environment.
And I guess we'll know when you feel like you're there, when you're ready to reinstate your forward guidance. What's your thinking about that? When do you think you'll be able to sort of give a good sense of what the next year looks like?
Yeah, so we'll do that in the new year. At CN, our policy has been steady for the last 25 years. We don't provide quarterly guidance, and providing guidance this week would have been the same as providing a guidance for the fourth quarter. So we won't do that. Our statistics on volume, though, are published every week, so people can actually make up their own opinion as to what the remaining of the year will look like. But when we come back in 2021, assuming that the economy continues to be slowly improving and the future is a little more clear as to what kind of mix of business we'll have, we should be in position to provide guidance for 2021. But broadly speaking, we're cautiously optimistic about 2021. Mm-hmm. But right now, there's a good momentum that 2021 should be better than 2020.
We will have some, presumably a mini budget, a fiscal update this fall, presumably also stimulus spending aimed at restarting growth, not just kind of staunching the bleeding from a pandemic. In terms of your business, what would drive, as you note, energy may be in a real cyclical change here long term. What would drive your intermodal business? What would drive the traffic for you that would help when you're thinking about government programs and ways to get the economy going? What do you hope for?
The thing that probably has the biggest and shortest term impact is consumer confidence. The disposable income of consumers and what they do with it, especially if they go and consume, and that creates a very positive environment for import business, intermodal business, housing, anything related to housing. Infrastructure is also very positive, but infrastructure takes time, meaning there's not that many projects that are truly ready, shovel ready for 2021. And energy, hopefully in the energy space, hopefully Alberta and energy can actually come back on its feet at some point, because that's also very helpful to the whole country, but also to people like ourselves who are involved in moving commodities over a very long distance. So I'd say consumer first, infrastructure second, and energy is a whole card. Hopefully Alberta and Canada can help them out.
We did see your efficiency ratio higher than I guess some would like to see it. Just in terms of your own operating business, maintaining your costs, et cetera. What's your focus there?
Yeah, so it was 59.9 operating ratio, which is a good ratio in our view, especially when you come back from kind of a weak July towards stronger September. And also there has to be a balance, Amanda, between how this whole pandemic is on our people and how also the financial performance. So we can't do everything related to costs, which is, chop. We have to face ourselves to look at 2021. We have to look at long-term future and what we need in terms of talent and technology to be ready for 21, 25, and 2030. So the operating ratio is just one of many metrics, but we're not focusing on having the lowest operating ratio and be too much short-term focus. But we're looking to have a very want to be a leader in cost operating ratio at the same time as not damaging our future, and also be mindful of our people.
All right, JJ, it's always great to have you with us. We do appreciate it. JJ Ruest is the CEO of CN Rail.